Welcome, ladies and gentlemen. My name is Peter Yusuf, Senior Market Analyst of IronFX, and together we'll be going through a presentation of the week ahead for the markets. Now, before we start, let's go through our risk warnings and disclaimers. Now, as you are reading, let me make a small intro. Now, we are reaching the end of a week which seemed to be characterized by worries for inflation and the US debt ceiling, along with an energy crunch. At the same time, we must note that the release of the US employment report for September is still pending, as these lines are written, and could create additional mayhem in the markets. Opening a window to see what next week has in store for the markets, we highlight the release of the Fed's meeting minutes on Wednesday. In regards of the monetary front, also a substantial number of monetary policymakers from the US as well as other countries are scheduled to speak and could create substantial interest among market participants. Now, as for financial releases, after a rather quiet Monday, on Tuesday we get UK's employment data for August, while on Wednesday we note UK's GDP rates for August and most importantly the US CPI rates for September. On Thursday we note the release of Australia's employment data for September and later on the US weekly initial jobless claims figure, while on Friday we get the preliminary US University of Michigan consumer sentiment for October and the US retail sales for September. And with no time to waste, we move to the US dollar, and this would be the USD Index for our chart. Now, the US dollar index seems to be moving in a sideways motion between the 94.60 and the 93.70. We tend to maintain a bias towards that direction, and we tend to note also the 94.10 as a support line, which tended to provide some support yesterday. Lower than that, we have already mentioned the 93.70 and even lower than 93.20. To the upside, we note the 94.60. Higher than that 95, and even higher than 95.45. Moving now to USD's fundamentals, the USD seems to have been confined in a sideways motion against its counterparts in the past few days. Now, the resolution of the US debt ceiling, even temporarily, seems to have brought a more optimistic mood in the markets on Thursday. US lawmakers voted to extend the limitation on the US government's borrowing in order to avoid a possible default of the US government. The extension is to span until early December, bringing a relief in the markets. We must also note that the US yields are at rather high levels and seem to be rising even further, and if so could provide further support for the USD while have an adverse effect for US stock markets, especially the high-tech sector. Also, the price of gold could drop should US yields rise, as rising yields could prove enticing for non-interest-bearing gold In international politics, we note that tensions in the US-China relationships seem to ease given that Biden and Xi plan US-China virtual summit before year's end, according to media. Should there be further easing in the tensions of the US-China relationships, we may see the USD experiencing some safe haven outflows. On the monetary front, we highlight the release of the Fed's September meeting minutes, and should the document reaffirm the bank's hawkish tone, we may see the greenback getting some support. Also, the worries about inflationary pressures in the US economy are still present, therefore we expect the release of the US CPI rates for September, also on Wednesday, to be closely watched. On Thursday, we note the release of the US PPI rates for September and the weekly initial jobless claims figure. On Friday, we get the retail sales growth rate for September and the New York Fed Manufacturing Index, as well as the preliminary University of Michigan consumer sentiment, both being for October. Moving now to the pound, and this will be cables for our chart. Note the sideways movement achieved in the past few days, just around the 1.36 level, which is currently a resistance level as the price action is just below it. Now, to the upside, we highlight also the 1.3750, which provided some resistance that was back on the 24th of September. Higher than that would be the 1.3875, which served the pair well. That was on the early September as well as 9th of September. To the downside, we mentioned the 1.3430, lower than that the 1.33, and even lower as the ultimate bearish scenario, the 1.3190. Moving now to the pound's fundamentals. Now the pound seems to have gained somewhat against the USD, Euro and JPY in the past few days, albeit the bull's action seems to remain somewhat capped. Fundamentally, the situation in the UK remains worrying, as there seem to be shortages from time to time in food and fuel, as well as other consumer goods. Shortages seem to be caused by a lack of heavy goods vehicle drivers, as well as other overseas workers due to Brexit, and the situation got even worse by the COVID pandemic. Now, UK Prime Minister Johnson promised change, yet such a restructuring of the UK economy may take time, which in turn could have adverse effects on its recovery. Also, inflationary pressures seem to be present for the UK economy, and businesses are reported to expect further price hikes for their end products, implying that the issue is far from over. The situation seems to intensify BOE's dilemma to tighten its monetary policy, as on the one hand, hiking rates could tame inflation, yet at the same time could undermine the economic recovery. Now, on UK's fundamentals, we also must note some tensions with the EU about their post-Brexit relationship, as France was reported threatening the UK with a power cut in order to leverage better access to fishing waters. As for financial releases, GBP traders are to have a rather interesting week, as on Tuesday we get the UK employment data, and on Wednesday we note the release of the UK GDP rates and manufacturing output rates, all being for August. Moving now to the Japanese yen, and this would be USDJPY for our chart, where we have practically an upward direction which has been renewed in the past few days, should become even clearer should the pair break above the 112.25. To the upside, we also note the 112.90 and the 113.70, while to the downside we note the 111.65, lower than that the 110.90, which provided considerable support at early October. Lower than that we have the 110.20, which was a prior resistance line, now turned to support. Moving now to JPY's fundamentals, JPY seems about to have its fifth consecutive week of losses against the USD, despite some strengthening at the beginning of the week, and since Monday is also losing ground against the Euro and GBP. It should be noted that Japan's parliament elected Mr. Kishida as its new prime minister Monday, yet there seem to be worries about his ideas for a new capitalism, as included in past week's report. Now, it's characteristic that Nikkei had some sharp losses on Monday, suffering a Kishida shock, as the new leader was reported to have suggested tax hikes. On the other hand, a wide number of Abe's associates are within Kishida's current team, which could moderate any policy shifts. We must also bear in mind that the Japanese yen, besides the national currency, is also considered to be a safe haven, hence we would not be surprised to see it also reacting to any tensions in the international politics, as well as any problems in the global economic recovery. On the monetary front, BOJ Governor Kuroda is reported to have stated that Japan's labor practices keep wage pressures under control, which, in our opinion, could have an adverse effect on inflation. The situation for Japan's economy seems to be even gloomier in the eyes of BOJ, as supply bottlenecks seem to limit production output and thus exports, according to a quarterly report of the bank, which is vital for the Japanese economy. As for financial releases, we would like to note the release of the corporate goods prices for September on Tuesday, while on Wednesday we get the machinery orders growth rate for August. Moving now to the common currency, and this would be EURUSDs for our chart. Now, the downward motion of the euro against the USD seems to be unstoppable, and we tend to highlight to the downside as the first support level, the 1.1520. Lower than that could be the 1.1445, and even lower the 1.1370. To the upside, we note the 1.1615, higher than that the 1.1695, and even higher the 1.1780. Now, we tend to maintain a bias for a bearish outlook for the pair as long as it remains below the downward trend line. Moving now to the fundamentals for the common currency. The single currency's weakening against the USD seems to be unstoppable, as we have mentioned. This is its 5th week in the reds. European fundamentals cannot be iterated without mentioning the energy crunch suffered by the continent. Despite comments made by European Energy Commissioner Simpson that the area has enough gas in storage to last through the winter, worries are still present. It's characteristic that German stocks dropped substantially on Wednesday, yet recovered on Thursday, as Russian President Vladimir Putin stated that they are ready to help stabilize the global energy markets. Now, the statements caused a temporary correction of Dutch and UK natural gas prices, yet the market seems to remain rather volatile and uncertain. However, a substantial increase of Russian exports of natural gas to Europe may entail a quick certification of Nord Stream 2, which was halted by European courts and some European states may be unwilling to allow. Overall, the situation underscored the energy dependency of Europe to Russia. On the monetary front, reports that the ECB is studying a new bond buying program when the PEP program is to be phased out next year highlighted the bank's dovish inclination. As for financial releases, we note on Tuesday Germany's CEF indicators for October and on Wednesday Eurozone's industrial production for August. Also on Wednesday and on Friday we get Germany's and France's final HICP rates for September, albeit the preliminary releases may have already absorbed most of the market's reactions. Moving now to the Aussie, and this would be AUDUSDs for our chart. Now the pair has been moving in an upward motion. Note though that the pair has broken the upward trend line incepted 2 days ago. Nevertheless, there seems to be also an upward trend line which runs deeper and could provide some support for the pair at a higher level. For the time being, we maintain our upward outlook and we tend to note as support lines first the 0.7280. Lower than that, the 0.7225. See how it supported the pair. And here, and here, and here, and here. And even lower than that would be the 0.7170, which is the lowest point in our chart right now. Moving now to the upside, we note the 0.7335. Higher than that would be the 0.7420, and even higher, the highest point in our chart would be the 0.7475. Now moving to Aussie's fundamentals, the Aussie seems to be in a sideways movement for now between the 0.7335 and the 0.7170, but we would like to note that that's for a 3rd week in a row. It should be noted though that the Kiwi against the Aussie seems to be strengthening notably. On the AUD's fundamentals, we note the possible easing of the tensions in the US-China relationships that could benefit the commodity currency, as China is one of the main trading partners of Australia. It should be noted that China's energy crunch could expand more the Sino-Australian trading relationships, as Australia could provide the coal needed. On the other hand, iron ore seems to have stabilized at low levels, which could be adverse for Australia's exports. On the monetary front, RBA's widely expected decision to keep rates unchanged at 0.10%, a record low, passed largely unnoticed by Aussie traders. The bank also is to purchase government securities at the rate of $4 billion Australian dollars a week until at least mid-February. Overall, the bank's dovishness seems to be steady and may weigh somewhat on the Aussie. As for financial releases, Aussie traders' focus is expected to be on the release of Australia's employment data for September on Thursday. Aussie traders may also be on the lookout for China's trade data for September on Wednesday and CPI rates for the same month on Thursday. Moving now to the Canadian dollar, and this would be USD CADs for our chart. Note how the pair has practically escaped the bearish trend line to the downside, breaking the 1.2580, which was a support line, now is turned into a resistance line. We expect the pair to maintain its downward motion as long as it remains below the downward trend line, characterizing its movement. Now, to the downside, we note the 1.25, which provides some support. for the pair. Lower than that, the 1.2425, and even lower, the 1.2330. To the upside, we note the 1.2650 and the 1.2720. Moving now to the CAD's fundamentals. The CAD seems to have escaped its inactivity of the prior week and seems to be strengthening against the USD in the past few days. The improvement of the market sentiment in the past days seems to have benefited the commodity currency, and should market optimism characterize the coming week, we may see the CAD getting some further support. On the other hand, oil prices remained a fundamental issue for loonie traders in the past 2 days, as the Canadian economy exports a high amount of the commodity. Oil prices seemed to suffer a bit on Wednesday, as surpluses of US crude oil inventories were reported by both AP and EIA for the past week. It should be noted that oil prices rebounded on Thursday and seemed to be aiming for a new multi-year high. A further rise of oil prices could provide some support for the loonie. On the other hand, news that the US is considering selling oil from its oil reserves did not go down well among oil traders. On the monetary front, BOC Governor Tiff McClellan stated yesterday that inflation could be a little more persistent, but assured Canadians that the bank will control inflation. As for financial releases, loonie traders are to have a rather light calendar ahead, as we get on Thursday the manufacturing sales and on Friday the wholesale growth rates for August. Now, before we end the presentation, as a closing comment, we expect volatility to be maintained given the high amount of financial releases, while at the same time some degree of uncertainty remains in the fundamentals. Now, the release of the US employment report today, depending on whether the rates and figures take the markets by surprise, could create volatility in the coming week and alter the market sentiment. Please note that the release is expected to be closely watched also by FOMC policymakers. The USD possibly could maintain the initiative over other currencies, given the gravity of the US fundamentals and financial releases, yet other currencies could also be in the spotlight from time to time, as high impact data are expected also from other economies. Now, fundamentals mentioned at the beginning of the report, such as the energy crunch, worries for inflation, the Fed's intentions, and US yields, could continue to affect the markets as well in the coming week, with various degrees of intensity, depending on how the issues play out. Should market optimism prevail, though, we may see US stock markets getting some support. On the other hand, gold prices may have on display once again their negative correlation with the USD. Please bear in mind that all of the analysis above is made while today's American session is still to start, and given the gravity of the releases expected, could alter the direction of the instruments mentioned. From all of us here at IronFX, best wishes for solid trading.